If you're a business owner looking for a valuation, here's a quick primer to help you better understand how it's done. First, it's important to understand that most business valuations are at fair market value for tax compliance or other purposes. The IRS defines fair market value as the cash price at which property would change hands between a willing buyer and seller. In other words, the value of a business should be understood in the context of what someone is willing to pay for it in a market-based transaction. Next, let's discuss the components of value. Enterprise value, or total value of the business, represents the sum of all debt and equity capital invested in that business. Market capitalization, or market cap as it's referred to in the context of publicly traded businesses, represents only the equity value of that business. So to calculate enterprise value for market cap, we need to add the value of the company's outstanding debt, because debt holders are also investors in the business. Now let's focus on how enterprise value can be derived. First, we need to understand that buyers effectively buy the underlying cash flows of a business. The best proxy for cash flow is earnings before interest, taxes, depreciation, and amortization, or EBITDA. This represents the profits to the owner of the business before they pay interest on outstanding debt and taxes to the government. Depreciation and amortization are non-cash charges generated from fixed or intangible asset purchases that occurred in the past but are deducted from future income for tax compliance purposes. Also, EBITDA sometimes needs to be adjusted to reflect the true economic earnings of a business. So, for example, if the CEO or owner draws an above-market salary, or there are one-time or extraordinary expenses like a move or an inventory write-off, these can be added back to EBITDA. Let's talk about multiples next. A multiple is essentially the inverse of a return on investment, or ROI calculation. So, for example, if we pay a 5 multiple for the earnings of a company, we're effectively getting a 20% return, or 1/5 of our money, because it takes 5 years to recoup our initial purchase price outlay. Multiples vary by a number of factors, including company size, industry, growth rate, profitability, risk profile, and availability of credit. There are 3 basic approaches to valuation: asset, market, and income. The asset approach involves valuing the relevant equipment, property, or other assets of the business individually and summing the result. Asset valuations are time-consuming and costly because they usually require the physical inspection and appraisal of individual assets by an expert. The market approach uses the values of similar businesses that are sold on public stock exchanges or private business sales to other companies or investor groups, otherwise known as mergers and acquisitions, to approximate the value of a business. Finally, the income approach looks at the earnings and return on investment a business will generate in the future and discounts those earnings back to the present. With a comparable public company method, we look at how a group of similar publicly traded companies are valued. In this case, we're trying to value a restaurant, so we've pulled relevant statistics from several publicly traded restaurant franchises. As you can see, the enterprise value to EBITDA calculations for Denny's, DineEquity, otherwise known as IHOP, Bob Evans, Cracker Barrel, and Darden restaurants varies. However, the median multiple is 10.8. Now, if we're trying to use these multiples to value a relatively small private business, we should apply a significant discount, perhaps 35 to 45%. In our analysis of precedent mergers and acquisitions, we call a list of relevant restaurant sales that happened in the recent past. We can see that the median firm value to EBITDA of these 20 or so transactions is 4.9. Moving on to our income-based valuation methods, we see in the discounted cash flow analysis that a 5-year net income projection, we deduct changes in working capital and capital expenditures to calculate free cash flow. Based on an 18.5% cost of capital for this particular business, we discount all future cash flow to derive a present value of $783,000. Lastly, the leverage buyout analysis calculates return on equity and debt investments made in the business when it is hypothetically purchased in the present and sold 4 to 6 years in the future. So here in this output, we see that the equity investment yields a 29% annualized return in year 5. I hope this brief overview helped you understand some of the basics of business valuation. Here at Stanton Park, we'd like to help you with your business valuation needs. Please contact us for a free consultation at 781-228-3523 or john@stantonparkllc.com to learn more about how we can work together. Thanks for watching.